It's very common these days for taxpayers to have investments all over the globe. So a person might live in the United States or live abroad, be a U.S. person for tax purposes, and have income generated in a foreign country. Common question is, do you have to pay taxes on that income in the United States if you've already paid it in a foreign country? Typically, the answer is yes, but that doesn't mean that you'll have a net effective tax liability. So let's just run through a quick example. Let's say David is a U.S. person and he has $10,000 of foreign interest income. When David fills out his U.S. tax return, he'll include that $10,000 of foreign interest income on his U.S. tax return. Then, depending on what his U.S. tax liability is on his total income, will depend on what other income he has, and then whether he owes any taxes will vary based on if he paid taxes overseas. So, in one scenario, David paid 30% tax. There's a good chance he may not have much of any U.S. tax liability in the United States. In another scenario, he paid 10% tax overseas, and depending on his U.S. tax rate, he might have some tax liability in the United States. If he paid the exact amount that he would have paid in the U.S. in a foreign country, then you still have to do the calculation, but net effective, he not much of any tax liability in the United States.